Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. On this week's programme, we're talking about gold. Gold prices soared to another all-time high this past week, breaking through the $3,000 per ounce barrier. That saw the metal up 14% year-to-date, following a 27% gain in 2024. The last time bullion crossed a $1,000 threshold was when it broke through the $2,000 per ounce mark in August 2020 amidst a pandemic-driven surge. With the price having now reached UBS Global Wealth Management CIO's long-held target, the main question is, will this rally continue? Well, here to remind us of the recent history of the price of the yellow metal and to try and answer that key question about what might happen next, I'm delighted to welcome back to the programme our good friend Wayne Gordon, Managing Director in the UBS CIO in Singapore. Wayne, always a pleasure. Now, recap how we've got from that previous 2020 threshold, nearly 5 years back now, to this week's latest high. How do we get here, Wayne?
It's been a pretty remarkable journey, to be fair. One of the key things that has changed in the gold market, and we have noticed this over a number of years now, has been the stepping in of central banks to increase their overall reserves of gold within their total portfolio. Now, that has come about for a couple of reasons. Firstly, central banks have wanted to diversify their holdings of not just currencies, but also physical assets such as gold. As you know, we expect that inflation probably remains more elevated than what it has done in the previous decade. And the second has been around the situation with respect to the Ukraine war. And these events have led, in particular, a number of emerging market central banks, as well as some other central banks, both in Europe and in developed Asia, to step up their holdings in gold materially. Now, what we're talking about is in the decade of between 2010 and until 2020, central banks were buying around about 350 tons of gold to 400 tons of gold on average. Since 2022, central banks have been picking up over 1,000 tons of gold on an annual basis. So even though we had a couple of years of net outflows from exchange-traded funds, which traditionally would put downward pressure on gold prices, the step up in demand from central banks completely offset those outflows and actually saw gold prices defy what was a stronger US dollar and higher US real interest rates, which traditionally put downward pressure on gold. Gold prices continued to rise even though those other dynamics were moving in a different direction.
Yeah, it's an absolutely fascinating picture. And I guess the interesting observation that I'd make now is, I think that $3,000 per ounce target, that was the long-held target, wasn't it, indeed, I think, for you and your colleagues. And so I suppose the corollary question now is, what happens next? Does it rally? And you can maybe speak to some of the revised targets, I guess, that you and your colleagues are sort of suggesting now. But is there further still to run? Does the shiny metal have more luster to gain yet?
Yeah, well, look, I'd make a couple of points about that. So we've been long gold now in a number of our positions for around about 12 months, even a bit longer, actually, about as far back as December 2023. And part of the reason why we moved to hold that long position for such an extended period was the fact that we could start to see that central banks' rates were picking out and cuts were imminent. And not only that, but also we expected this sort of elongated period of high demand for reserve managers within central banks. So when we were sort of setting these targets, it was under those sort of conditions. However, what we needed to see was a return of ETF funds into the market. This was critical to begin to step the price even higher. And so we have seen very strong momentum across the board in exchange-traded funds across almost all regions over the last sort of 6 months or so. And that, again, this momentum has led to gold prices hitting that $3,000 target. At the same time, we think that momentum can continue. And largely because of the risks that have emerged since Donald Trump took the presidency and how those risks are starting to work their way into broader investment portfolios. And so for a long time now, we have advocated that for long-term diversification in a portfolio, you should be holding around 5% gold. We're starting to see investment managers who've been under-allocated to gold begin to step those allocations up. And that's what we're seeing come through in the ETF market now. Now, we know that a lot of the risks around trade and tariffs, how countries retaliate or respond to those tariffs that the US are looking to bring on over the next, potentially as early as the 2nd of April, we know that these risks will not go away particularly quickly. And so you need to have a diversifier or a hedge in your portfolio, and gold has continued to exhibit very good qualities in that hedging capacity. The second point I'd make is that we know that tariffs are inflationary, albeit maybe just for a short period, but we know that they're inflationary. And gold has also shown itself through certain periods to be a good hedge against higher prices or inflation. And at the same time, we're observing expectations for US growth coming down. So those conditions, i.e., I suppose that more stagflation type narrative is starting to return to the market. And at the same time, that is unlikely to be positive for the US dollar and could also mean that real interest rates in the US begin to come off more quickly. That be the case, that could be another boost for gold. Hence the reason we've moved our target to around the $3,200 an ounce mark.
Absolutely, Wayne. Can I just ask you, in terms of the sort of geopolitical dimensions, you've alluded to some, not just trade and tariffs, of course, but the volatility from conflicts and this kind of thing. We know those things are, that kind of volatility is hard to price in because it's unpredictable. It's not, these things don't tend to work cyclically as some other economic trends do. I mean, not even looking just through the prism of the gold price, but just generally, I mean, how challenging is that kind of dynamic for you and your colleagues? Because you have to try and make sense, you have to try and give this good, comprehensive advice. And these things are, by their nature, volatile and unpredictable. Just as I said, with it from more of a headline view, just remind us how difficult a job that can be.
No, look, it's certainly incredibly unpredictable. And look, as we've seen in the last week, you know, there was some expectation building that we would move to a ceasefire arrangement between Russia and Ukraine. Clearly, with recent news flow, that's looking increasingly unlikely in the short term. Not only that, but also when we look at recent Trump administration pronouncements, they clearly also want to potentially increase sanctions on Iran. These things in themselves, while the timing is relatively very unpredictable, at the same time, some of these things the Trump administration have been discussing since their first term in office. And so I guess it comes down to probabilities and how you perceive the probability of some of these events either being more prolonged or actually deepening and getting worse. Now, clearly at the moment, you know, we hope that there is a ceasefire arrangement between Ukraine and Russia, and we hope that that comes as quickly as possible. But at the same time, we have other emerging geopolitical risks, such as these issues between the US and Iran. So often you get, you know, probabilities for one thing begin to improve, that these things will start to get solved. But then in the other side, additional risks begin to pop up. So from our perspective, that's why we see gold as a long-term portfolio hedge, where there are periods which are appearing to be less stable. There you want to increase your hedge. And of course, as things begin to get solved or things begin to simmer down, you tend to start to take profit or wind down that hedge a little bit. But the point is that you need to hold that sort of position in gold over the long term to get those diversification benefits.
Wayne Gordon bringing us to the end of this edition of the Bulletin with UBS here on Monocle Radio. Listen again and explore more at monocle.com. Don't forget you can also discover more and find out how UBS can help you by visiting ubs.com. This is the Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.